So, hello there. How's everybody doing today? It is Tuesday, June 17th, and I am Angela Williams Graves, a licensed associate broker and realtor with Rose and Wamble Realty Company. And I am here and excited today because we have guests who are going to talk to you about credit, repair, and mortgage loans. So if you have seen my video, you will know that it's not a big deal if you have some blemishes on your credit. It's not the end of the world, but understanding your credit is very important in today's society, and it affects everything that we do, not only from just purchasing a home, but also as far as employment is concerned, and being able to get a car or get a good rate on a credit card. So there are lots of reasons why credit is important, and understanding your credit profile is important. And so today I have two wonderful guests. I have Siobhan Johnson, who is a credit specialist, and then I also have my main money lady, Marian Uzzle, who is a mortgage loan officer. So one of the things that I pointed out, I think, in my video was, if you don't have good credit, you certainly can't get a mortgage. So we're going to talk to you first about credit and finance, and then we're going to talk to you about getting a mortgage loan. So I'm going to bring Siobhan in. And hi, Siobhan.
Hi, how are you?
I'm well. How are you doing?
I'm great.
Good. So we're going to talk. I'm going to bring the presentation up here and get this into our slides. And like I said, Siobhan is a credit specialist, so she's going to talk to you about credit, the importance of it, what she does, and how we can help you. So take it away, Siobhan.
Hi, I'm Siobhan Johnson. I am a credit specialist with United Credit Education Services. And just a little bit of background about who I am. I've been doing this for the past 12 years, and I've been helping a lot of people to get their credit restored and actually make home ownership a actual reality.
Mm-hmm.
But prior to then, I was in the IT field for the past 20 something years. And of course, when the market crashed and the market changed, things changed for me as well.
Mm-hmm.
The company that I work for is called United Credit Education Services. They've been around for the past 17 years. We've helped over 160,000 clients actually get their credit restored, to purchase new homes, to purchase cars, to refinance, to get credit cards, to basically to make credit worthy.
Mm-hmm. Mm-hmm. So what you're saying to us, Siobhan, is that you're not a novice. You know what you're doing.
Exactly. I'm not a novice, and my company is not a not. Yeah, my company, we're not a fly-by-night company as well. Like I said, we've been around for the past 17 years.
Mm-hmm.
We've helped clients get over a million, probably close to 2 million now. The way that our rate has been going, derogatory
Mm-hmm.
items off of their credit lines, including 300 to 400 public records. Public records are tax liens, judgments, bankruptcies, child support, those things that are public records. We've also gotten those items off credit reports as well.
Great.
So
Great.
let's talk about why this is more important than ever, because it used to be a day when cash was king. Cash isn't king anymore. Credit is king. And right now they're saying that the single biggest difference between financial success and financial failure is how well you manage your money. And right now, based off of these economic times, we as Americans, we are just, we're not managing our money.
Right.
COVID-19 is taking off and everybody is like scrapping. The unemployment rate is ridiculous right now. But there are a few Americans out there that can still purchase, but they still have credit issues.
Mm-hmm.
And,
Mm-hmm.
and it's unfortunate that we were not taught financial literacy growing up. And,
Right.
through high school and college or whatever. However, we are starting to do that now. My company, actually, we are educating youth from the ages of 8 to 18 on financial literacy, going around to local schools,
Wow.
educating. Right now, with the COVID going on, we're doing webinars. They do
Mm-hmm.
classes. We're doing classes online. The kids actually can take a financial literacy class. So let's talk about the 5 shocking things that you don't know about your finances. One of the shocking things are Americans are drowning in a total of a $1.57 trillion in debt, in credit card debt, in
And
credit
that's
card
trillion
debt
with a T,
alone.
right?
Huh?
That's trillion with a T, right?
A trillion, not a billion, but a trillion.
Wow.
A
Wow.
trillion, a trillion, and it's ridiculous in credit card debt alone. 56% of people in the US have no rainy day funds. So when we tell you to, the churches save 10%, you need to save 20%, maybe 10% to go to the churches, if for your religious beliefs, and then you need to
Right.
save at least 10% because we have no rainy day funds.
You know what, Siobhan, I'm going to jump in here because there is a pastor. His name is Jeffrey Guns. He's in Norfolk, and he said something one Sunday I was at his church that was incredibly life-changing for me. And it kind of goes along the lines of what you're talking about with the rainy day fund. He said to tithe 10%, save 10%, and invest 10%. And that really
Yes.
was life-changing for me because I started with the principle of getting $1,000 in a rainy day fund. But if the average emergency is $500, then my $1,000 is gone. But
Yeah,
if I make
$500. Your car breaks
yeah,
down, $500. You need a new
exactly.
refrigerator. You need something in the house.
Mm-hmm.
It's a minimum
Mm-hmm.
$500.
Mm-hmm. So that
Yeah.
that save 10% is absolutely that's right on point. That's right on
Yes.
point.
Yes. No rainy day funds. And then you have 46% of baby boomers. They have less than $10,000 saved in their retirement.
Wow.
Yes, saved
Wow.
in their retirement. And that is not good. Not good at all.
Mm-mm.
Then
Mm-mm.
40% of the millennials, the young kids, they have spent
Mm-hmm.
money that they don't keep. I mean, that they don't have just to keep up with their friends, but they don't let their friends know this. Nobody knows this. Their friends don't know, the parents don't know, but they try to keep up with the Joneses, as my grandmother used to say. You're trying to keep up with the Joneses,
Mm-hmm.
and
Mm-hmm.
you
Mine
can't do
too.
that anymore. And then you have,
Mm-hmm.
I mean, this number right here, it says 43 million, but this number has gone up tremendously from the past year.
Mm-hmm.
This number is like 67 million Americans have a credit score of 500 or 99 or less,
Wow.
which is
Wow.
ridiculous. I mean,
Wow. And they don't
poor,
have to.
no, you don't have to. And poor credit actually gives people anxiety. They're embarrassed, they're frustrated, they feel like they can't do it, they have fear, they're confused.
Mm-hmm.
I mean,
Mm-hmm.
I remember when I was in a situation where I was about to die because my credit score has slipped up
Mm-hmm.
under 620. It had got to yeah, it had got to like 605, and I was just like, and I know I was trying to get a home, and
Mm-hmm.
I was telling my real estate agent, I was like, I have messed up. I don't know what I'm going to do. This is what I
Mm-hmm.
said, what can I do? I said, I'm at 607. The loan company called me, said I was at 607, and that was my median score. And
Mm-hmm.
they needed me to be at least at 620, and I would
Mm-hmm.
prefer to be at 680. I was like, I don't know what happened. She said, what happened was you went out there and bought that car. That's what happened.
Mm. Oh no, you
And
didn't.
Yeah, that was pre-days. That was like 15, 20 years. That was about 20 years ago. Yes, ma'am.
Oh,
Yes, I did.
wow.
And then she sat up there and she coached me. She said, look, it's nothing to be ashamed of. It happens all the time. We just got to get you back going.
Mm-hmm.
And I was like, okay, because I need to be back to where I need to be again, so I can feel like I'm confident that I can do this and everything is going to be great again. And I know that, ultimately having a good credit score, it can just open up a gateway for everybody. Absolutely. And everything. I mean, we can get new cars, new homes. We can have low interest rates on credit cards and loans. We can have higher credit limits. We don't have to put that $150 down to get a T-Mobile or a Boost Mobile phone bill. Phone account, cell accounts, or we don't have to get a
prepaid card because you have no credit.
Right, paying $5,000 deposit down on a car note. I don't have to pay a deposit that's equal to my first month's rent. Just trying to get an apartment. So with all that being said, let's talk about how your credit is calculated. Your credit is calculated in 5 different areas. You have 35% of your payment history. What you guys have to understand is you have to pay your bills on time. That is 35% of your credit. Paying your bills on time, 35% of your credit history. Not paying it 30 days late, 45 days late, but paying your bills on time. And then the amount that you owe. So banks tell you if they give you a $5,000 credit limit, they don't want you to have no more than 30% used. So that means no more than $1,500 need to be used on that credit card. No more than $1,500. So when you do have $1,500 charged on that credit card, pay it off. Pay it off as soon as you can. Don't run it past $1,500 because that's when your credit scores drop. Then the length of your credit. A lot of people think, oh, I've only had this credit card for 10 years, so I'm going to close it out. Don't close it out. Keep that credit card open. Keep it open. That's history. That's history. And that takes up about 15%. And then stop going into these stores and they offer you a credit card. Don't do it. Those are new inquiries. Those new inquiries take up 10% of your credit score. You don't want that at all. And then you got the types of credit. You have revolving credit. You have installment loans. Revolving credit can be K Jewelers, bills like that. JCPenney,
your Value City credit card or something like that, right?
Credit cards, Marlowe Furniture credit cards, things of that nature. Do not do anything like that takes into accountability as well.
And installment loans are like your student loans or your car payment, right?
Exactly. Installment loans are student loans, car payments, house notes.
Right. Okay. Those are your installment loans. Okay. All right. Cool.
However, we do have credit restoration where you can clean up your credit so you can get these new homes, new cars, new loans. 60% of employers, do y'all know that they run a credit check on your jobs? And that's very, very high, especially if you work for the federal government. You actually have your credit reviewed. I have a lot of clients that I have dealt with in the past. They work for the federal government and their jobs depend on their credit, and they're coming back. They're saying, hey, look, my credit is jacked up and I actually need to get my credit restored or show my employer I'm in your credit restoration program because my job is depending on it. And I cannot, I have got to show them that I am in credit restoration and I cannot not have my credit clean.
Security clearances matter too, because security clearances, especially in federal government, require good credit scores.
Yes. Security clearances are the number one reason why credit is run by the federal government. You want to have this top secret or poli-sci secret, whatever, whatever clearance that you want to have, they run your credit. And most people don't know 4 out of 5 credit reports have errors on them. Those errors, your name could be William J. Smith, but they call you Bill Smith, and you go by Bill Smith on applications, you go by Bill Smith on your taxes, you go by Bill Smith on any paperwork that you have except your birth certificate. Well, that's an error on your credit report. That is the error. If it says William J. Smith, but you know you don't go by William J. Smith, you go by Bill J. Smith, that's an actual error on your credit report.
Wow, I didn't know that.
Yeah. Your address could say 12416 Chautauqua Lane. That's your correct address. However, your address is 12416 Chautauqua Street. That's an error on your credit report. Yeah.
Wow.
Yeah, those things right there, the small things, the small things make a difference on your credit report. And people don't know that if you get those small things removed off your credit report, your scores can go up 40, 50 points.
Wow.
Yes. And over the past decade, millions of Americans have watched their credits rapidly decline, like I said, because of these tough economic times. And look at what's been going on with us in the past 4 or 5 months with this COVID virus.
Right.
Everybody's credit has been shot. However, there is a solution. You can restore your score. The Fair Credit Reporting Act, which gives Americans the right to dispute and or investigate any item on their credit report, was enacted by Congress in 1968. This act says that inaccurate, erroneous, and obsolete items such as late payments, charge-offs, repossessions, collections, short sales, bankruptcies, tax liens, medical bills, judgments, foreclosures, they all can be removed from your credit profile or be reflected as paid as agreed. And a lot of people don't understand that. They think that when Joe Blow Collection Agency calls them, that they have to make an agreement with Joe Blow Collection Agency, and that is not true. Once an item goes into collections, the item has been charged off by the original account holder. You don't have to make a payment agreement with the collection agency. You don't have an account with the collection agency. You have an account with the original account holder.
Wow.
Yeah.
Wow. You know, that's very interesting, because I know Marion is going to come on next after you and talk about mortgages. But one of the things that we do talk about in our class, we teach VHDA workshops every month, or at least we did before COVID-19. And that's one of the things that when we're looking at mortgage loans is that they are paid, like collections are paid. And there, you know, in some mortgages, there are some collections that you don't have to pay. But the main thing is not that you had the collection, but that it's showing as paid. And that makes a big difference in your score if you've got it. And it is at least showing paid, right? And not just sitting out there like, you don't care.
Right. Well, see, what happens is the credit agency, okay, so you're going to have that actual debt on your credit report from the original account holder. Then you actually have a collections on your credit report from that same account. That is duplicate. That is a duplicate account, and it should not be up there. So you have 2 actual accounts, one from the collection agency and one from the debt holder. And both of those items are taking your credit scores down.
Wow.
So Right. If one says paid and the other is still sitting up there, it has to be removed. And basically, we try to get both of those items removed because it was paid.
Okay. 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 Cool
Yeah, so that's
beans.
what it
I
shows.
didn't know that.
So yeah, that's what it shows. It shows the collection account, and then it
Mm-hmm.
also shows the original account.
Okay.
I have a young
Okay.
lady right now. She has a student loan with Sally Mae,
Mm-hmm.
but then Sally Mae turned it over to no, she consolidated with Navient or whatever.
Navient. Yes, I have Navient. I
Yeah,
hate
she
that.
consolidated
Okay.
with Navient. And so it looks like she has 18 student loans.
Oh,
And
wow.
yes, because she did the loan consolidations. And initially she only had 8 Sally Mays. No,
Okay.
10, no, it was 9 Sally Mays. And then Sally Mae sold it over to Navient. So Navient looks like it has 9. So it
Yeah.
looks like she has 18 student loans. And it dropped her
Wow.
credit score down 100 points. We
Wow.
actually got the Sally Mays removed. And we actually got Navient's removed as well.
Wow.
Yeah.
Wow.
So let's talk about how long does the negative items have to stay on the credit report? People have the myth that negative items stay on your credit report for 7 years, 12 years, 10 years, 12 years. That's not true. There's not a law that says a company has to keep your item on your credit report. There's not a statute of limitation that says that a company has to keep it on your credit report for 7 years, 10 years, 12 years.
Okay.
And then people ask, well, is credit restoration legal? Yes, it's legal because it gives you the fair, like I said, the Fair Credit Reporting Act gives you the right to dispute anything on your credit profile. People ask me all the time, how much will my credit, with my services, how much will their credit scores increase? I tell them all the time, everybody's credit profile is different. I can't tell you how much this is going to increase. However, I do see clients' results in 45, 60 days in our program, and I've seen tremendous results. I had a young lady yesterday to send me her results back, and she hadn't been in our program 30 days, and her scores went up 156 points.
Wow. Wow.
And then the infamous question, I'm quite sure you probably get it too. I can sell a house on my own. I can buy a house on my own. Can I restore my own credit? Sure. You can restore your own credit. But why would you? Why won't you let a professional help you? Would you go to the court and you just committed murder and actually go there without a lawyer? Would you repair your car's engine without a mechanic? Yeah, you can do all of those things, but why would you? Won't you let a professional like myself guide you into the right things to do the right way so that you can be financially free?
And I know, I think too, Siobhan, what happens with people is that they hear all kinds of stories and they hear all kinds of horror stories or what have you about people who just jump in to, they claim, I guess they get laid off from their job and they go get a business license and they claim they're a credit specialist and they don't know diddly squat about what they're doing. And so for me, what is extremely impressive is, your longevity in doing this work and then having the team that works for you to get these things done in a manner. Because you make a very good point. Why would you go in front of a judge if you committed murder without an attorney? So why would you try to, you can write letters and all of that, but why would you try to restore your credit not knowing the law that allows you to be able to do those things?
Absolutely.
So you get like one or two things done, but you can't utilize the full extent of the law if you don't know it.
Yeah. And that's what we have all the time. I get those questions all the time from clients. I'll get somebody and they come to me now and they say, hey, well, why can't I do this on my own? Okay, well, if you want to do it, well, I found some letters on Google. Google is the devil. Google will have you do everything in the world except what's right. That's what I say all the time. Google will sit up there and tell you that you got this and got this and got that and all of that. Google is the devil. I don't know. And then you get those people that go out there. Well, I went out on Google and I Googled this and they said I can do this and I'm going to call the credit bureaus and I'm going to do this. Okay, go right ahead. Go right ahead. But one last tip I do want to tell viewers is this.
Okay.
Absolutely do not dispute anything that you have over the phone with the credit bureaus, because that waives your rights. That waives your rights to have the items deleted in the future. That waives your rights to any type of representation or anything by any credit attorney or credit specialist. Do not dispute online.
Okay.
Do not do the disputes online. They will say.
So you mean like from a Credit Karma or something like that, where you can do
Karma, Experian, any credit bureaus. All three credit bureaus, they offer a way for you to dispute online, but you are waiving your rights. You're waiving your rights from the Fair Credit Reporting Act up there to dispute anything else on your credit report.
Okay. All right. Cool beans.
Okay.
Well, hang out with us for a little while, and folks can post questions in the comment section, and we'll answer those if we have them at the end. I am going to bring in my main money lady, Marion Uzzle. And Marion, I am tickled pink with this because I'm having so much fun with this platform. It's just I am really enjoying working on this. Wait a minute, did I get that gone? Hang on, I've done something. Okay, here we go. I got it now. I'm working this out. I'm working this out. So today we have the second half is my main money lady, Marion Uzzle. You all who follow me on social media have probably seen us tag together in various workshops that we've done, and in various transactions and closings and things like that. And so what she's going to do is she's going to talk to you about how to get a mortgage loan. So if your credit isn't perfect and you've gone to Siobhan and she's worked through your issues and helped you to get your credit restored and helped you to get your credit score together so that you can purchase a home, Marion is going to talk to you about how to go about doing that. So what I'm going to do is try to make sure I get this screen back up where I started it from. And we're going to try to get this back where it came from. Oh, all right. I think I got it. Okay, I do. All right, here we go. So is it going to let me start from where let's see, what's it going to do for me here? Okay, it's making me start from the beginning. All right, here we go. Hang on.
All right, no problem.
Right. Gotta love. Okay. All right, so here we go. Marion Uzzle, Fulton Mortgage. Yep, gotta love the technology. Fulton Mortgage Company. And I'm going to kind of kick this off with, why do I need a mortgage loan? And the simple answer is, if you're paying cash, you don't. If you've got a shoebox full of money, or if you've got money buried in the backyard, or if you've got money in your 401 savings account, or if somebody died and left you, couple $300,000-$400,000 and you want to pay cash, you don't have to get a mortgage loan. But about 80% of homes that are purchased use a mortgage loan, and the mortgage loan is the tool in which a lender pays off the seller, and then you pay back the lender the money that they basically advanced for you. So Marion, talk to us about the various types of mortgage loans.
Okay, all right. Well, thank you, Angela. I'm glad to be here today. And So as Angela mentioned, I am a mortgage loan officer. Actually, I'm a Community Reinvestment Act mortgage loan officer, which means that I can offer a number of different grant opportunities, programs to help with down payment assistance and closing cost grants. So that's a great thing to be able to offer to the community. As far as the types of loans, we have conventional loans. Conventional loans, you're able to make a down payment as low as 3%. Conventional loans do have private mortgage insurance, which drops off over the life of the loan. FHA is a minimum down payment of 3.5%. It also has mortgage insurance that remains throughout the life of the loan on an FHA loan. Both of these types of loans do require down payment because the goal is to get 100% loan when you're purchasing a home. Just like when you go to buy a car, if the car is $20,000, you want the bank to give you $20,000 so that you can buy the car without any money down. Well, it's the same thing when you purchase a home. You want to get 100% loan. And that's what we offer. That's what we offer you. That's what your loan officer can help you get approved for. There's also rural development loans, which are loans that you get approved for when you purchase a home in a rural area. And most of the areas around the 757 are not considered rural, but there are some small areas considered rural, Pungo, Blackwater, Isle of Wight, Gloucester. So purchasing a home in those areas will allow for the rural development loan. They require a guarantee fee, and the guarantee fee is included in the mortgage loan. You finance it there. Then there's a VA, which is 100% loan. And for all you veterans, thank you for your service, but you're eligible for a VA loan. And also, if you're a surviving spouse of a veteran, you can take advantage of the VA loan, and they require a funding fee. And then the one that Angela spoke about earlier, we teach classes for VHDA loans around town. And you can get 100% loan with the VHDA, and that's your down payment portion to go along with an FHA or a conventional loan. And that loan also has mortgage insurance that doesn't drop off automatically. So those are your different loan types, and more than likely you will fit into one or more than one of those different loan types.
Now I'm going to stop and pause you here for a second because I want to invite folks, if you did not see my very first episode webinar of So You Want to Move, or Are You Ready to Move? There's an example there of that 100% piece when it comes to down payment and your mortgage loan. And you can visit my YouTube channel at Angela Graves. You can visit my YouTube channel and pull that up and see that example there as well.
Thank you, Angela. You know, for most people, buying a home may be the largest transaction that you will ever make, and being a homeowner, it's a major financial responsibility. And most times we ask ourselves, well, you know, how do I know if I'm ready? Well, the key is good planning. And good planning to me means educating yourself, and you should educate yourself about any major financial responsibility that you're about to walk into. And that's why there's great opportunities to take classes, which most do not cost you. It costs someone, but it doesn't cost you. And take advantage of those opportunities, and we'll be more than happy to help you, direct you, schedule you, get you set up so that you can do that. Most of us have an insatiable appetite for information, especially if we're always out on the internet searching for things. And so you want to satisfy that appetite. Let's talk about pre-qualification and pre-approval. I know you hear about this often. What's the difference? Pre-qualification, you call your loan officer, hey, Marion, I'm interested in purchasing a home. Can you help me? Absolutely. So I ask you some questions regarding yourself, your financial obligations, pull your credit, and take a look at your credit to see where you are. Look at your debt to income ratio to see where your numbers are. And you can pretty much be pre-qualified just like that, looking at that general information. But we want to take it a step further. Taking it a step further means that you provide documentation and general things, pay stubs, bank statements, tax returns, W-2s, things like that. And then we take it a step further to get you pre-approved. That way you know exactly where you are, and your realtor knows where you are. And most agents do not want to take you out to see properties unless they know your buying power. You know, you want to be able to present to your realtor that you can afford something, and you don't want to go out and you're looking at a home for $250,000 and you can only afford $200,000, or you're looking at a home for $200,000 and you can only afford $175,000. So we want to know exactly where you are, and a pre-approval is the ideal way to determine that.
So Marion, you and I have been doing this for a long time, and we got stories, and our stories got stories. But one of the main, I think, examples of this was a gentleman that we had that he called me. He had been pre-qualified online. And he called me. He wanted to see a house. He said he had been pre-qualified. Okay, great. I prefer to work with Marion, but I will work with anybody. If they're legit, I'll work with them. And he'd gone online. He had done everything. And he says, here's my letter. I've got it. It's for like 200,000, I think is what the number was. And so as we were talking and I was showing him homes, I was talking to him about using a local lender, because this was one of those .com people that, you know, I still couldn't get in touch with on the telephone and actually verify that they existed. And so finally he consented, and he said, okay, fine, give me your lady's name. I'll call her. I'll do the application. So he did do exactly what I told him to do. He went online. He did the application with Marion. He submitted over his bank statements, and he submitted over his paycheck stubs. And Marion, I know you know who I'm talking about. What was on his paycheck stubs?
He had a significant amount of child support that he was paying. Yeah. And
child support is a debt, right? Just like any other debt in your debt to income ratio.
It's a financial obligation, and it did not allow him to qualify for what he originally thought he could buy. And so that's why it's very important to provide your financials.
He went from about 200,000 to about 78,000 in one swell swoop. He was not happy, but we didn't make the kids, so it is what it is. So what happens at loan application, Marianne?
Well, at loan application, we talked about the things that you would provide. Loan application here talks about us gathering 6 pieces of information, as you can see listed there. And the 6 pieces of information come along with after you have gone under contract. You found a property that you're interested in, the contract is ratified, the lender now, we have received your contract, and it provides us with the amount of the property. And so we're able to determine your loan amount in that instance, and it's in the estimated value of the property until an appraisal is done. And that helps the lender to actually get your file going now that we have the ratified contract. So those pieces of information are very important. And then after that, we put together a loan estimate. And most of us want to know, well, what do my numbers look like? How much is my mortgage payment going to be? How much am I going to be bringing to closing? We're concerned about how much the seller has given you in closing costs. So we put those numbers together, and you're able to receive a loan estimate. And that loan estimate is just what the title says. It is an estimate of all of the costs associated, most of the costs associated with your loan at that time. And the words are really small, so I can't see them, but I'm sure that you can see that the points, the appraisal, the survey, things like that, that will be listed there so that you'll have a better idea of what those costs are.
Now, Marion, I'm going to jump back to pre-qualification and pre-approval for just a moment, because in our class, we talk about comfort level, and we talk about the finance number and the difference between what you're comfortable with and, you know, what you can be financed for. What is that? Talk about that a little bit.
Well, yeah, I think it's important to know your comfort level. And there's a tool that VHDA provides, which I encourage a lot. And that is a spending plan. And the spending plan, in fact, I talked to a couple on yesterday, Tuesday, and they have gotten approved to purchase a home, but they're not really sure where they want their payment to be. And they know what price point they want to buy in, but they're not sure where they want their payment to be. So my homework to them is always take the spending plan, fill it out, be honest with yourself when you fill it out, so that you can know for yourself without a shadow of a doubt how much your mortgage payment should be after all of your other expenses. Because your loan officer, the lender, we're only going to take into consideration what's on your credit report. But we know that you have other financial obligations outside of your debts that's showing on the credit report. So we want you to have a comfortable payment when you're at application, so that you know the price point that you want to be shopping in. And trust me, that spending plan, it should make you feel some kind of way if you're filling it out honestly. Because most of us don't look at ourselves on paper, and this is a time where you will, and you'll be able to determine what your comfort level is when you're looking to get approved for the mortgage loan. So that's really important.
Mm-hmm. Mm-hmm. So who's who in lending?
Good question. Who's who in lending? You have your team of people. You have your lender, your processor, and your underwriter. Your lender is your loan officer. Your loan officer is your person that's your primary point of contact. We're going to take the loan application. We're going to collect your financials. We're going to put your numbers together. We're going to talk about various programs that are out there, the ones that allow for grant opportunities. If you're eligible, we're going to talk about those. And we're going to see which one of the programs you can fit in to best. We're going to prepare the loan application for the next person, who may, in some instances, be the processor, or it may be the underwriter. And those people are on the team as well. So let's say it's the processor that gets the file next. So the processor will handle the processing of the loan application. They will sometimes order the appraisal, order insurance, order the title, verify employment, things like that. Most times the file will go directly to the underwriter. And of course, if it's going directly to underwriting, you want to have a clean file. That means that as a loan officer, I'm going to be asking you very specific questions, very important questions, collecting as much information as possible. So it's really crucial that you're honest with your loan officer, because if we don't get all the information and we find out things in the middle or towards the end, it could really impact you moving forward with purchasing this home. So the underwriter is the most important person on our team that you will not get to verbally interact with, because they have to make a decision around the loan based on everything in black and white. So it's very important that we provide a clean file. Now, moving on to interest rates. As you see here, it says the higher the interest rate, the higher the payment. However, in this environment now, with COVID and a lot of things that's happening out there, it has caused us to be in a lower interest rate environment, which is fantastic for the housing industry. And it's a great thing, as we know. So when you go under contract, that's the time when you can get locked in, because your interest rate is tied to the address on the property. And when you're locked in, your interest rate is guaranteed for a fixed period of time. And we want to make sure that the interest rate does not expire. So please make sure that you're sticking to the time frames and you're providing what's needed at the appropriate time. And you want to meet your closing date, and so do we. Most loans now are a 30-year fixed, but if you want an adjustable rate mortgage, your loan officer can talk to you about that as well. Now, next, PITI, P-I-T-I. That is how your mortgage payment is broken down. This right here, this is how your mortgage payment is determined. The principal, interest, taxes, insurance. When you stroke the check every month and pay your mortgage, every part of that mortgage payment is being distributed to one of these areas. The principal is the remaining balance of the loan, the original balance. The interest is tied to the interest rate. So that determines the amount that is going to be paid over the life of the loan. The taxes are different based on the city in which you purchase your home in. It varies. And just about every loan, actually every loan, you're going to have insurance. Some loans are going to require mortgage insurance and some not. And then you also have the hazard insurance, your homeowner's insurance. You get to choose your carrier, and the bank gets to choose whomever the default insurance is. But the PMI and MIP stands for private mortgage insurance and mortgage insurance premium. And those are insurance premium that are paid to the lender in case of default. Okay?
And the only way you get around that is if you put 20% down, right?
Or if there is a program, and we offer a number of them, if there's a program that you can qualify for that exempts mortgage insurance, and ask about that, because the less you have to pay on a monthly consistent basis, the better. And but for most, yes, it's 20%, and so who has 20% lying around to avoid having to pay mortgage insurance? So that's an important piece, Angela. So yeah. Escrows, most of us have heard of that word and wonder, what does it mean? All it means is the taxes and insurance portion of your mortgage. So you make your mortgage payment every month. Let's say you get a VHDA loan and you're making your mortgage payment to VHDA. The mortgage payment is $1,000 a month. And $100 of that $1,000 is going towards the real estate taxes. So every month that you pay that $1,000, VHDA is going to take out $100 and put it in your escrow account with your name and account number on it each time you make the mortgage payment. They're going to do the same thing with the insurance premium. And let's say the premium is $50 a month. So that's $150 going into your escrow account. Well, once a year, your homeowner's insurance carrier, they will send a bill to VHDA to collect those $50 that you've paid for 12 consecutive months. They're going to send the bill for that $600. VHDA is going to go into your escrow account, pull out that money, and send it over to your insurance carrier. Same thing with the real estate taxes. The city of Norfolk, Chesapeake, Portsmouth, whatever city you purchase your home in, and however often they bill for real estate taxes, let's say it's quarterly, every 3 months, VHDA or whomever your servicer is will get that bill. They'll go into your escrow account and send them the money because you've already paid it. You may receive the bill also, but you're not required to pay it because it's already been satisfied. So that's how your servicer works. Appraisals and home inspection. Okay, so this means that you're getting towards the end when it's time for that appraisal. In the beginning, you're having your home inspection. The home inspection checks the systems of your home. You get to be there at the home with the home inspector, walk through the home, find out what's going on with it, go over the report and figure that out. The appraisal determines the value of the home. We want to make sure that you're not paying more for the home than what it's worth. So that's the appraisal. Once you have your home inspection, you pay for the inspection at the time the inspection is done, and the appraisal, that's taken care of as well. When is closing? Everybody wants
a $50 million question.
I tell you, everyone, when am I going to close? When is closing? What happens at closing? Well, you're not going to close if you haven't provided all of the conditions that's needed from your loan officer. We have to turn those remaining documents into underwriting so they can be signed off on. So delayed documents mean delayed closing. Nobody wants to hear that. So make sure that you're on top of it out the gate in the very beginning. But if you close during the first 5 days of the month, then your mortgage payment will be due the following month. So let's just say everyone is going to close on July 1st. then your mortgage payment will be due August 1st. If you have your closing July 6th or anytime thereafter, you will not have to make a mortgage payment in July. Your first mortgage payment will be due September 1. Okay, so when do you want to close?
The 6th or after. And I can tell you, people will do that. They will wait. The loan officer or the processor will ask for documents, and they think they can wait it out, thinking that they have a closing date and we've got to close. Oh, no, we don't.
Yeah.
We will wait until all the documents are in, and everything that you send to the loan officer has to go to underwriting, and it has to be approved by underwriting. And then the whole file has to go to compliance, and then we can close. So you can't wait out stuff thinking that just because you got a closing date, that's going to happen for you, because that date will come and go just like another day of the week. Marion will go home to her house, I'll go home to my house, and you may be without a house if you don't do what it is that you're supposed to do. The other piece to that we often talk about, Marion, in the class is because oftentimes buyers don't understand that they're not just buying a home that doesn't have any attachments to it. The seller of that home may need to sell their home in order to buy another home. And so when you delay and you don't do the things that you're supposed to do in order to meet your closing date, it can create a domino effect. And that seller is going to be really annoyed with you. And if you need any kind of special concession, you're not putting yourself in the best light in order to get the seller to work with you when you're not doing what you're supposed to do. And so we always tell people, if you have questions about something that's being asked of you, if you have questions about documents that you have to provide, it's usually nothing that we haven't heard or don't know how to help you get. But we do a lot of things well. Mind reading is not one of them. And so we don't know if you don't tell us that you are having, you're having issues. So Marion, you said earlier that you were the community resource loan officer for Fulton Mortgage Company. So talk to us a little bit about the different programs, the specialty programs that you all offer at Fulton Mortgage Company.
Yeah, thanks, Angela. As the Community Reinvestment Act loan officer, I am, my focus is on making people aware of grant opportunities that are out there that you can take advantage of. One of them that we offer is the CCAP, is Closing Cost Assistance Program, where you can get up to $2,500 to go towards your closing costs and down payment. And this is very helpful for both sides, for the seller as well as the buyer. So if the property is in a certain location, we can check the map to see if it's eligible for closing cost assistance program, which is fantastic, a great way for you to have to bring less to closing, or as the seller to provide less to the buyer for the CCAP program. So we just take a look at the map, take a look at your numbers, make sure that you're eligible, and voila. We also offer the First Front Door program, which is the Federal Home Loan Bank, and that's $5,000. So you can either reduce your buying power by $5,000 or increase your buying power by $5,000. So let's say you're approved for $200,000 and you want the property that's 205. Well, there you go. There's the $5,000 grant. You must be a first-time home buyer, and there are some household income limits that come with that. And so we just check the guidelines to see if you're eligible, and hopefully you are. Also, VHDA, which is you must be an authorized lender to offer a VHDA product, and at Fulton we are. And so there's a number of different programs that VHDA offers that can be put on top of both of our grants. So you can get that 100% and that additional $5,000, the additional $2,500, and also the different cities offer different grant opportunities. Chesapeake offers 13,000, Portsmouth 14,000, Norfolk 40,000, Suffolk 14,000. So, just ask. If you're ready to do this, feel free to reach out, and I'll be more than happy to share with you what opportunities are there for you based on your personal criteria. Okay.
Great, 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 great. So what I have at the end here is my contact information here. I also have, if you have specific questions, because the information that we're providing you with today is generic, and it's general information as it pertains to the general loans of guidelines. But if you have specific questions or personal questions regarding credit, Siobhan's information is here. You can call her or email her and ask. Her website is here, as well as Marion's information. If you think you're ready and you want to purchase or you want to know where you are, Marion's information, website information, phone number and email are also here, so that you can contact either of these individuals who are very knowledgeable and in what they do, and really care about working with the community and working with folks to help them to become homeowners and to get their credit and their mortgage loan approved. So I just want to say thank you to everyone for joining us. Siobhan, I appreciate you being here.
No
And Marion, I also appreciate you being here. I like to put together people who will do a good job for my clients. I know that a lot of times folks will call me and they'll say, hey, do you know somebody that can help me? Or, hey, what do I do about my credit? And Mary and I have gone through some credit people, and they haven't proven to be reliable. And so when I found Siobhan, it was God said, I was like, oh my God, where have you been all my career? Because that is an important part of the puzzle. And even if you're not ready to purchase a home, you don't want to wait until you are ready to purchase before you get started, because depending on where you are, it can be a process. So thank you, ladies, for being here, and thank everybody for watching. We will be back in 2 weeks with another segment. Stay tuned to my social media channels to find out what that topic will be, and tune in. Have a good day. Stay safe, and be blessed. Here we go. All right.